So, after several years of saving money, watching your expenses, working on your credit, you finally put together enough funds for a down payment. You call me, you say, "Hey Esteban, I've been working really hard. I put money together for a down payment. What are my options?" And I say, "You know what? That's fantastic. It's great to hear you've put money together for a down payment. Have you put some money together for closing costs?" And the answer to that, I don't know. So a lot of times when I'm working with clients, they aren't aware that there are costs outside of just the down payment to finalize a real estate deal. And these costs can actually add up. So today I'm covering exactly, what are they, what do they consist of, how much they are, and how you minimize these costs. So what are the closing costs? So as I mentioned, they are costs to finalize a real estate transaction. When you're doing a real estate deal or refinancing your loan, there are multiple parties involved in that transaction outside of just a real estate agent. Now, the real estate agent commissions actually don't consist of these costs. Their commissions are generally paid by a seller. The closing cost amount, however, which is great about this, is it can be paid by the seller or split between the seller and the buyer. Now, what do they really consist of? Well, a big piece is the lender. Most lenders, all lenders will have different structures or fee structures, but typically some common items, you'll see an origination charge. If you're buying down your interest rate, there will be points, also known as discount. You'll potentially have a processing charge, credit report, and some other smaller fees. It just depends on the lender. Now, there will also be a third party that handles the money, known as title and escrow, and they ensure that the contracts are being followed. They handle the monies between the two different parties, buyer and seller. And then they also provide what's known as a lender's title insurance policy. And this is an insurance policy to protect the lender against, a claim being made in the future on the title, right? So say, for example, a seller inherited a property, right? Or the person you bought a property from had inherited that property. And later down the road, a family member of that old seller comes back and says, "Hey, I never got paid. I had an ownership stake. I never got paid." Well, if they take legal action, that's what the insurance policy is there for. It's to protect their interest in the home. Now, you'll also have an appraiser as part of the transaction. Of course, when you're purchasing a home, you want to ensure that the house is worth, at least what you're paying for it. And the same goes for a lender. A lender doesn't want to lend more money than what a house is actually worth. If you're doing a government loan, you'll have upfront fees, and most of these fees will be 1% or more, just depending on the government program. Now, these fees can be rolled in to the loan on these government loans in most cases. However, you are paying interest on that additional principal that you're borrowing. So they are a cost and generally pretty high for government loans. Going on to the next slide, prepaids. So depending on when you close in the month, you're going to pay prepaid interest for the remaining days of that month. So if you close, say, on the 15th and you have 15 days left of that month, the lender will collect prepaid interest for the remaining days of that month. Then the following month, your new mortgage starts. They'll also collect an annual premium for your homeowner's insurance. And this is collected upfront as part of your prepaids. If you're putting less than 20% down on your loan, you're going to be required to escrow your payment. So your payment must include the taxes and insurance, or the average of the taxes and insurance over the 12 months. So when you're creating or originating a new loan, the lender will collect money for taxes and insurance for this escrow buffer. Depending on where you get your mortgage or where you're buying your home, the county will charge a fee to record a new mortgage. In Arizona, most counties usually pretty inexpensive. However, other counties across the United States can be very expensive. They can be above $1,000 to record a new mortgage. So that can also, that's another item that can add up pretty quickly. How much on average do these closing costs usually come out to be? Well, depending on the loan program, you're looking at 2 to 5%. If you're looking at a government loan, you're probably looking closer to that 5% amount. Now, how do you go about minimizing these closing costs? Well, in terms of the lender charges and the lender costs, the lower your loan to value is, right? The more equity you have in the property, the better deal you're going to get on your loan. And the same goes for the interest rate, right? If you have a better credit score as well, you'll be able to minimize your closing costs. Depending on the property type, your closing costs may change. So if you're looking at condos or townhomes that have an HOA, those typically have transfer fees and possibly other fees that they require you to pay in advance to finalize that real estate deal. If you're looking at a manufactured home, that may also have additional costs, such as an engineering certification, or if a home sits on a well or uses a septic tank, then there are added costs to ensure that the properties meet the standards to fund that loan. The loan program is probably the biggest element. If you're using a government loan, you're just going to end up having to pay those costs or roll that amount into the loan. Now, really, in most cases, if you don't have the money for closing costs, a lot of people don't. The biggest way you're going to be able to avoid having to pay them is if you can negotiate for a seller to pay those costs. And how you do that is you purchase a home in a balanced market. So if you're trying to negotiate your closing costs when it's a seller's market, right, when there isn't much inventory, interest rates are very low, you're going to have a tough time getting 2 to 5% to finalize your real estate deal. So for those individuals that don't have a lot of flexibility in terms of their cash on hand to get into a home, it's best if they purchase a home in a more balanced market so they don't have to cover those costs themselves. I hope this information is useful to you in learning a little bit more about what purchasing a home and the costs entailed in doing so. If you'd like me to elaborate more on a specific item, let me know. I plan to elaborate a little bit more on a few as I go through different loan programs. However, if there's a specific one you'd like me to do, keep me posted. I appreciate you watching this video.